Okay, welcome to this video in which we're going to specifically explore covered bonds, one of the products that comes from ABS or securitizations. It's not really a true ABS, that's the problem. Nevertheless, the curriculum talks about it as one of the sort of the specific ones, although mentioning it's not a true securitization. So we already discussed them a little bit in a previous recording. So let's just start with some basics. They are going to typically be issued by financial institutions. In fact, very popular in Europe, where I come from. Institutions. Okay, they represent typically a form of senior debt, or they are senior debt, and they are backed, as all asset-backed securities are, backed by a pool of assets, typically loans, typically mortgage loans, but the thing here is it's a segregated pool of assets. As we said, typically mortgage loans. Mortgage loans originated by the financial institutions, financial institution being the issuer. And as I said, the thing you probably need to appreciate is that this is not a true securitization. And the reason for that is that the assets are not sold to an external entity and they're not removed from the bank's financial institution's balance sheet. So not true securitization. Why? Well, because the loans forming that segregated pool of assets called the cover remain on the bank's balance sheet. Remain on the bank's balance sheet, so they're not removed, they're not decoupled. The only thing that happens is, this is important, the loans are sort of segregated, as I said before. Another, I guess, more technical term to use here is that the loans are ring-fenced. And that ring fencing is all about creating a separate group of assets, sorry, not to cover, but to create what's known as a cover pool, right? That's the technical name for that grouping of assets, that segregated pool of assets. Right. Okay, if you look at this from the perspective of the investors who hold covered bonds, so investors in covered bonds, I mean, what do they receive? They receive repayments of principal. They also receive interest. So just like you would get, principal and interest in bonds, receive principal and interest payments. However, the thing is, in case of default, that's the default of the issuer, the financial institution behind these securities, behind these bonds. In case of default of the issuer, so I could have written this as issuer default, I guess this would have been easier. What you have to bear in mind is that these investors have what's known as dual recourse. So two ways to try and recover their money. One is that they've got recourse, so the ability to claim money out of the cover pool. So they've got recourse on the cover pool, to the cover pool. And secondly, they've also got recourse on any of the other unencumbered assets of the bank, on any unencumbered assets of the issuer. So imagine, that the bank defaults on its payments under the cover bond, and you try to recover money from the cover pool, and if that's not sufficient, there's still the possibility to claim any missing money, any missing payments from any of the remaining assets of the bank, but taking into account the fact that certain assets may be pledged as collateral specifically against certain securities that have been issued. So whilst you need to observe that hierarchy, once again, the cover pool is not the only source of potential, getting any repayments in case of issuer default. And one thing that your book mentions, I'm going to write this down as well, is that covered bonds are a relatively popular way to get funding, to get finance, to finance renewable renewable energy projects. It doesn't mean you have to use them to set up wind farms or solar farms, etc. Project stroke infrastructure. For example, green buildings whose construction is modern enough so as to comply with certain renewable energy concepts. Buildings that don't use up a lot of energy, I guess, may be financed using what we call green bonds. Okay, and in the case of green bonds, the cover is typically going to be mortgages, so loans made by banks to finance the construction, finance the purchase, right? So-called green buildings. So buildings that comply with various environmental, tough environmental norms. Okay, let's now focus a little bit more on the details. So some very common features. Let me write typically. Covered bonds have the following characteristics. It's going to typically be only one class of bond or one tranche of bond per each cover pool. So one class of bond, and let's say only, right, as opposed to numerous subordination sort of tranches, etc., being created in other places. One class of bond per cover pool. So quite a straightforward thing here. The cover pool, remember, those are the ring-fenced, segregated loans, assets that are cash flow generating. Cover pool is going to be monitored. That's going to happen. That's going to be done by an external sort of third-party monitor, and the monitoring is going to, what is the monitoring going to be about? On the one hand, performance, how well that loan, for example, is performing, whether it's being paid on time, etc., etc. Because if not, there are provisions in the agreements to potentially replace it, but also compliance with standards. So there will be various standards set out for which loans may be included in the pool. They may relate to things like loan to value ratio, and somebody needs to effectively, in an objective way, monitor whether those standards are being upheld and complied with. If not, that calls for replacement of a specific asset in the asset pool with something better. Okay, let me write that down. Any either prepaid, some loans may be prepaid ahead of schedule, or indeed non-performing loans, or loans that drop below the preset standards. They must be typically replaced by the issuer of the whole thing, so as to ensure adequate cash flows, right? To ensure proper cash flows, adequate cash flows all the way until the covered bonds maturity. Until covered bonds maturity, whatever that maturity may be. Okay, let's now think about how you could potentially lower the risk associated with some of these issues. So there are a couple of things that you need to know about that get used to lowering the risk to investors. Okay, and like we've seen before in many places, and we'll see again as well, one of the simplest way to lower the risk being faced by investors, this is, credit risk, is to apply the concept of over-collateralization. Collateralization, and that simply means it's very easy. The value of the collateral that you use as cover in a covered bond should be higher than the face value of the bonds being issued. Face value of bonds issued, and that provides some excess, right, which is there to potentially absorb losses. That's very easy. Second of all, the loans. And remember, we're typically talking about mortgage loans, right? So the loans included in the cover pool will typically have to meet certain standards. Those standards very often relate to loan to value characteristics. So not only are you making sure that the overall value of the loans is accordingly higher than the face value of the bonds being issued, the loans themselves have to be over collateralized as well, meaning, if you have a house and it's worth 100, that's the value element. The loan you're going to get from the bank to finance the purchase of this house will not be 100, maybe it will be, 75. So that will create a loan to value ratio which is less than 100%, which once again creates a buffer, of course, as we said before, if a specific loan during its lifetime, maybe due to the house value falling instead of rising, drops below a certain predefined LTV level, it will have to be removed from the cover pool and replaced with something that is compliant, right? So, very simple concepts when it comes to improving or increasing the the safety or lowering the risk as faced by investors. And there's one more here, because there are 3 different ways in which this risk may indeed be lowered. And the final one relates to what we call redemption regimes. I'm going to tell you what that is in a moment. It's a little bit more technical. It's what will happen in the event of the issuer going into default. So in the event of the issuers, that's the bank, default. The issuer here is also known as the sponsor of the covered bond, right? But it's really the bank here. What happens if they go bankrupt? Well, there are some possibilities, and I guess you need to know the names and roughly what they mean. Okay, it gets a bit technical. The first one is a so-called hard bullet covered bonds. And what will happen here is that if the payments to investors are not on schedule, so we're talking about the payments made by to the covered bond investors, that will trigger a bond default. Bond default is effectively triggered. Triggered, double G, triggered, and payments get accelerated. Okay. Beyond, accelerated relative to what they would be under the standard schedule. Okay, that's a hard bullet covered bond. Now, the second, as you may sort of probably guess, is going to be a soft bullet. So, soft bullet covered bonds. And that's going to be a lighter version. With this one, you don't automatically trigger a bond default. There will be one, but a bond default and payment acceleration is delayed until some new what they call final maturity date, new final ultimate maturity date. Okay, and it's going to be typically something like up to 1 year from the original maturity date. Okay, from the original maturity date. And sorry, and there is one more that you need to know about. It's nothing about hard or soft bullets or any type of bullet. It's called a conditional pass-through. Conditional pass-through. I've been using the plural form covered bonds here, so I'll have a plural conditional pass-throughs over here as well. And well, they're conditional. Wait, let me write this again. They're conditional pass-through covered bonds. So the plural form will be once again in the bonds. Conditional pass-through covered bonds. Apologies for that confusion. And what will happen is, if there are missed payments, if the issuer is not paying, basically if the issuer defaults, these covered bonds automatically convert to pass-through securities. Well, they do after the original maturity. So, providing when the original maturity date comes, you don't get the money. There is no delay, with a sort of postponement of the final maturity, as would be the case with soft bullets. It doesn't trigger an automated default and payment being accelerated here. After, if at your original maturity date, if all payments effectively have not been received by investors, this type of security converts to a pass-through. So it just starts to give you whatever payments come from the borrowers who are sort of behind the cover pool. Right. In any case, there is a lot to be said for covered bonds in the sense of having this, let's say, this dual recourse. Sorry, that wasn't the most fortunate of colours. Let me take that back and use a different one. You know, the dual recourse nature, that you've got kind of two sources of cover here. The fact that they are typically senior, they are monitored, they're over collateralized. They, you know, the loans in the pool must meet certain standards. All of that means that covered bonds are typically going to be regarded as relatively safe, definitely lower risk, and therefore also generating a lower yield than your typical asset-backed securities, your typical ABSs. Obviously from the same issuer, and that's due to the safety features we just discussed. And one way of thinking about this is that investors are not really exposed to the cover pool, because they're not getting cash flows which are a function of how somebody's borrowing their loans. It's only if the financial institution issuing these things defaults are you getting backing from the cover pool, but that's in the event of a default. So investors are not exposed to the cover pool or the risk of it, just backed by that collection of loans. And you know, if you think about this from a bank's point of view, from a bank's point of view, we know there is no removal of assets from the balance sheet. So no removal of loans from assets. And as a result, there is also no freeing up of capital. No freeing up of capital at all. You know, the capital is kind of still frozen up, so you can't do this. So it doesn't have the same effect as a standard ABS would. However, it is a way, on the positive side, right? So positively, it's a way. This is a method of getting your hands on longer term, LT means longer term in my world, longer term funding at a lower cost. Definitely a lower cost than would be associated with issuing unsecured debt. Right, that's effectively the point. It's not the cheapest thing. There are cheaper methods, but it's relatively safe, regarded as safe by investors, and investors who hold these things are willing to, let's say, lower their expectations of yield because of the safe nature. So, you know, there is a trade-off here, as with most things.